I'm about to show you something most traders never see. A live breakdown of two traders. Same setup, same market, same opportunity. One trader makes $400, the other loses $200. It's not because one is smarter, it's not because one has a better strategy, it's psychology. And today, I'm breaking down exactly where it happened. Let's go. This is the Euro-Dollar 4-hour chart, Tuesday morning, New York time. Let me show you exactly what we're looking at here. The setup. Price bounced off a clear 50-day support level at 1.0800. RSI came down to 28, oversold territory. Volume spiked on the bounce, more buying pressure. We have a clear risk-reward ratio of 1 to 3. This is a textbook setup. High probability, clean entry, defined risk. Both traders see this setup. Both recognize it's good. Entry level, 1.0850. Stop loss, 1.0800, 50 pips below. Target, 1.0950, 100 pips above. Risk, $200, 50 pips times $4 per pip. Potential reward, $600, 100 pips times $6 per pip. Risk-reward ratio, 1 to 3. Both traders have the same account size. Both are risking 2% of their $10,000 account. Now, here's where the story gets interesting. Both traders enter at 1.0850. Same exact price, same exact time. The market is now in motion. What happens next separates winners from losers. Let's call the first trader Trader A. Trader A has been trading for 3 years. Win rate 54%. Risk per trade 2%. He's solid. Not perfect, but solid. The trade enters. Price is at 1.0850. Everything looks good. Minute 1 to 5. Price holds around 1.0850. Trader A feels confident. This is going to work, he thinks. Minute 5 to 10. Price moves against him. Now at 1.0835. He's down 15 pips, down $60. He's still 35 pips from his stop. He's fine. Logically, he knows this. But psychologically, something shifts. Minute 10 to 15. Price continues down. Now at 1.0825, down 25 pips, down $100. Trader A is now feeling uncomfortable. His stop is still 25 pips away, but his mind is racing. What if this continues? What if I'm wrong about this setup? He's not thinking clearly. He's thinking emotionally. The moment of truth, minute 15. Price retraces to 1.0820. Trader A is now down $120. That's when his psychology breaks. He looks at his P&L, minus $120. He looks at the chart, still dropping. He thinks, this is not working. I'm already down. Maybe I'm wrong. His fear takes over. His mind is screaming, get out now! So he does. He exits at market price, 1.0815. He locks in the loss, minus $140. What happens next? The irony? Within 2 minutes, the price bounces, 1.0825, 1.0835, 1.0850, 1.0880, 1.0920, 1.0950. The trade hits the target that was calculated perfectly. Trader A would have made $600. Instead, he lost $140. The math. Expected profit from target, plus $600. Actual result from early exit, minus $140. Total swing, minus $740. That's life-changing money lost on one trade. Why did this happen? Not because his entry was wrong, not because his target was unrealistic, not because the setup was fake. His psychology broke. He couldn't handle 20 pips of drawdown without panicking. He confused short-term price movement, noise, with a signal that he was wrong. He treated a normal market retracement like a warning to exit. This is the mistake 90% of traders make. Now, let's talk about Trader B. Same setup, same entry price, same account size. Trader B has been trading for 8 months. Win rate, 48%. Lower than Trader A. But Trader B is about to show you something crucial. Minute 125. Price enters at 1.0850. Trader B feels nothing special. He already decided at entry, this trade has a 55% probability of hitting the target. He knows there's a 45% chance it hits his stop. He's made peace with this. The outcome is binary. Either he wins or he loses. Minute 5 to 10. Price drops to 1.0835. Trader B is down 15 pips. He notices it, but he doesn't react to it. Why? Because his stop loss is 25 pips away. This drawdown is normal. He's already mentally prepared for this. He expected the market to test his entry. He's not looking at his P&L. He's looking at the structure. Will this break my stop, 1.0800? Or will it bounce to my target, 1.0950? That's the only question that matters. Minute 10 to 15. Price continues down to 1.0825. Trader B is now down 25 pips. His stop is just 25 pips away. That's when his psychology is also tested. Fear is present. Uncertainty is present. But Trader B has trained his mind differently. He asks himself, is this a breakdown of my system, or is this just noise? The answer? My entry signal was good. The support level is holding. This is just noise. He takes a deep breath, and he stays. Minute 15 to 20. Price hits 1.0820, bounces back to 1.0825. Trader B doesn't panic. He waits. Minute 20 to 30. Price holds at support, 1.0800 area. Doesn't break. Trader B's conviction grows. The setup is working, just taking longer. Minute 30 to 45. Price starts moving up, 1.0820, 1.0840, 1.0880. Trader B doesn't get excited. He's patient. Minute 45 to 90. Price hits 1.0950. Target reached. Trader B closes the trade. Profit plus $600. The math. Entry at 1.0850. Max drawdown 30 pips to 1.0820. Stayed through it. Exited at target 1.0950. Profit plus $600. Why did this work? Not because Trader B is smarter. Not because Trader B has a better setup. Not because Trader B is more experienced. Trader B has better psychology. He separated the signal, good entry, from the noise, short-term price movement. He accepted that trades take time. He accepted that drawdowns are part of trading. He accepted that his stop loss defines his risk. Once it's set, he can relax. This psychology made him $600 on this single trade. The swing between Trader A and Trader B? $1,340 on one trade. Multiply that over 100 trades, and you're looking at $134,000 difference. That's not strategy. That's psychology. Here's what I want you to understand at a deep level. Trader A's psychology error. At minute 15, when he's down $120, his brain makes a conclusion. I'm losing money, therefore I must be wrong. This is confirmation bias. He's interpreting short-term loss as proof of a bad entry. But that's not how markets work. Markets move before they move in your direction. A normal trade might move 30 pips against you before moving 100 pips for you. That's just how price action works. But Trader A's brain doesn't understand this. His brain is wired for immediate safety. Losing equals danger. Danger equals get out now. This survival instinct is perfect for the jungle. It's terrible for trading. Trader B's psychology strength. At minute 15, when he's down $120, Trader B makes a different conclusion. This is noise. My setup is still valid. My stop loss is defined. I'll wait. This is systems thinking. He's separating the entry signal, good, from the price movement, irrelevant. 1. He knows that the market will either 2. Hit his stop, proving he was wrong, or hit his target, proving he was right. Both are acceptable outcomes. The process is what he's evaluating, not the momentary P&L. This mindset is harder to develop, but once you have it, you're unstoppable. Here's the key phrase: manage the signal, not the noise. The signal is the decision to enter the trade. The noise is every price movement after entry. Trader A confused signal with noise. Trader B didn't. Here's why most traders fail. They make the trading decision twice. First decision: does this setup meet my criteria? Answer: yes. Enter. Second decision: the mistake. Is it going my way right now? Answer: panic exit. Trader B makes the decision once at entry. After entry, he stops deciding and starts waiting. This simple shift in mindset changes everything. One makes $400. One loses $200. Both on the same setup. How do you become Trader B? It's not magic. It's training. Step 1. Define your rules before you trade. Not during, not after, before. Write down: when do I enter? Clear setup criteria. When do I exit winners? Target price. When do I exit losers? Stop price. What's my risk per trade? Percentage of account. What's my minimum risk reward? 1 to 2 minimum. Once these are written, you don't change them during the trade. Period. No maybes, no what-ifs, no exceptions, just rules. Step 2. Separate entry from outcome. This is crucial. At the moment of entry, you have conviction. You say, this setup has a 55% probability of working. Not, this will definitely work. You're betting on probability, not certainty. So when it goes against you 30 pips, you don't panic, because you expected that to happen 45% of the time. This is a mathematical fact. You're not wrong. The market is just taking the 45% route. Step 3. Train with 100 trades. This is where real psychology training happens. Don't take random entries. Don't exit randomly. Do exactly 100 trades following your rules perfectly, no matter what happens, no matter the emotions. By trade 20, you'll feel some discomfort. By trade 50, you'll have seen it all. By trade 100, this stuff will be automatic. Your brain will rewire itself. You'll stop panicking because you've seen 100 drawdowns. You know they're normal. Step 4. Track your emotional trades. Every time you break a rule, write it down. What was the setup? What was the emotion? What did the break cost you? After 20 emotional breakdowns, you'll see a pattern. Most traders break rules the same way every time. Once you see it, you can prepare for it. Example: I always panic when down $100 or more. Now you know your trigger. You can prepare. When I'm down $100, I'm going to take 3 deep breaths and remember, I expected this outcome. Let me give you a personal example. I used to panic exit winners. I'd be up $400 on a trade, see it retrace minus $50 and think, I should lock in this profit. Exit at $350 profit. Immediately after, the trade hits target for $600. I left $250 on the table. I did this 40 times in 1 month. $10,000 wasted. I finally saw the pattern. I said, I'm taking 100 trades. I will not exit early. I will hold every target. By trade 30, I was uncomfortable as hell. By trade 60, I was managing it. By trade 100, it was automatic. Now I don't even think about exiting early. My psychology is retrained. That took 100 trades. Not reading books, not studying psychology papers. Real money, real stress, real training. The lesson here is simple. Your strategy doesn't matter if your psychology breaks. 2 traders, same setup, $1,340 difference. That wasn't strategy. That was discipline. That was the difference between a trained mind and an untrained mind. If you're ready to train your mind, not just buy the next course on entries, like this video. Subscribe for live breakdowns that show you real trading psychology, and drop a comment. Are you more like Trader A or Trader B right now? See you in the next one.